To be sure, stock market returns sometimes get well ahead of business fundamentals, as in the late 1920s, the early 1970s, and the late 1990s, perhaps even today. But it has only been a matter of time until, as if drawn by a magnet, they ultimately return to the long-term norm, although often only after falling well behind for a time, as in the mid-1940s, the late 1970s, and the 2003 market lows. It's called reversion or regression to the mean, RTM, which we'll discuss in depth in Chapter 11. In our foolish focus on the short-term stock market distractions of the moment, we investors often overlook this long history. When the returns on stocks depart materially from the long-term norm, we ignore the reality that it is rarely because of the economics of investing, the earnings growth and dividend yields of our corporations. Rather, the reason that annual stock returns are so volatile is largely because of the emotions of investing, reflected in those changing P/E ratios. What Exhibit 2.1 shows is that while the prices we pay for stocks often lose touch with the reality of corporate values, in the long run, reality rules. So, while investors seem to intuitively accept that the past is inevitably prologue to the future, any past stock market returns that have included a high speculative stock return component are deeply flawed guides to what lies ahead. To understand why past returns do not foretell the future, we need only heed the words of the great British economist John Maynard Keynes. Here's what he wrote 81 years ago. It is dangerous to apply to the future inductive arguments based on past experience, unless one can distinguish the broad reasons why past experience was what it was. But if we can distinguish the reasons the past was what it was, then we can establish reasonable expectations about the future. Keynes helped us make this distinction by pointing out that the state of long-term expectation for stocks is a combination of enterprise, forecasting the prospective yield of assets over their whole life, and speculation, forecasting the psychology of the market. I'm well familiar with those words. For 66 years ago, I incorporated them into my senior thesis at Princeton University. It was entitled, The Economic Role of the Investment Company. It led, providentially, to my lifetime career in the mutual fund industry.